Today we will delve into financial statements and accrual concepts. So, what is the primary purpose of US GAAP? So, in the US, the Securities and Exchanges Commission (SEC) authorizes the Financial Accounting Standards Board (FASB) to determine the set of accounting rules followed by publicly traded companies. Under Financial Accounting Standards Board, financial statements are required to be prepared in accordance with US GAAP through the standardization of financial reporting and ensuring all financials are presented on a fair, consistent basis. The interests of investors and lenders are protected. So, what are the main sections of a 10K statement? So, in a 10K statement, you will find three core financial statements that are income statement, cash flow statement, and balance sheet. So, there will also be a statement of shareholders' equity and a statement of comprehensive income and supplementary data and disclosures to accompany the financials. So, what is the difference between a 10K form and a 10Q form? So, 10K is the annual report that is required to be filed with SEC for any public company in the US, while 10Q refers to the quarterly report that is required to be filed with the SEC. Compared to 10K, this report is 10Q is far more condensed in length and depth, with focus being on quarterly financials with brief sections for management discussion and analysis and supplementary disclosures. While 10Ks are required to be audited by an independent auditing firm, 10Qs are only reviewed by certified public accountants and left unaudited. 10Ks must also be filed 60 to 90 days within the fiscal year ending, whereas 10Qs must be submitted within 40 to 45 days of the quarter ending. So, what are the three financial statements? Income statement, balance sheet, cash flow statement. Income statement shows a company's profitability over a specified period, typically quarterly or annually. The beginning line item is revenue, and upon deducting various costs and expenses, the ending line item is net income. Balance sheet is a snapshot of a company's resources and sources of fundings at a specific point in time, such as end of quarter or fiscal year. Under the indirect approach, for cash flow statement, the starting item is net income, which will be adjusted for net non-cash income, non-cash items such as depreciation and amortization and changes in working capital to arrive at cash from operations. Cash from investing and financing activities are then added to cash from operations to arrive at net change in cash, which represents actual cash inflows or outflows in a given period. So, what are the items present in an income statement? So, the income statement shows a company's accrual based profitability over a specified time period, and facilitates the analysis of its historical growth and operational performance. So, if you'll see, the table below lists major income and expense components of an income statement. So, the typical components of an income statement are net revenue, cost of goods sold, and net revenue minus cost of goods sold gives gross profit less selling and administrative expenses less research and development expenses gives us earnings before interest and taxes and depreciation and amortization. And subtracting depreciation and amortization gives us earnings before interest and taxes. Less expense gives us earnings before taxes, and less tax experience and less tax expense gives us total net income. So the net revenue, the income statement begins with revenue, often called as top line, which represents the total value of all sales of goods and delivery of services throughout a specified period. Less COGS. COGS represent the cost directly tied to producing revenue, such as cost of materials and direct labor. Gross profit. Revenue minus COGS yields us gross profit. Less selling general and administrative expenses. These are the operating expenses that are not directly associated with goods or service being sold. For example, payroll, wages, overheads, advertising, marketing expense. Less research and development expense. Research and development refers to developing new products or procedures to improve their existing product or service offering mix. EBITDA. So the gross profit less selling general and administrative expense less research and development expense gives us earnings before interest, taxes, depreciation, and amortization. Depreciation and amortization is a non-cash expense that estimates the annual reduction in value of fixed and intangible assets. So EBITDA minus depreciation and amortization gives us EBIT, that is in earnings before interest and taxes. And on a EBIT minus interest expense net gives us pre-tax income or earnings before tax, and subtracting it with a tax liability recorded by a company gives us total net income, which can be referred to as bottom line. So what are the items present in the balance sheet? The balance sheet shows a company's assets, liabilities, and equity sections at a specific point in time. The fundamental accounting equation is assets equal to liabilities plus shareholders' equity. The assets belonging to a company must have been funded somehow. So assets will always be equal to sum of liabilities and equity. Asset section. Assets are organized in order of liquidity, with current assets being the assets that can be converted into cash within a year, such as cash itself, along with marketable securities, accounts receivables, prepaid expenses, and inventories. Long term assets include property, plant, and equipment, intangible assets, goodwill, and long term investments. Liabilities section. Liabilities are listed in the order of how close they are to community. Current liabilities include account payable, accrued expenses, short-term debt, while long-term liabilities include items such as long-term debt, deferred revenue, deferred income taxes. Shareholders equity section. This equity section consists of common stock, additional paid-in capital, treasury stock, and retained earnings. So, what assets, liabilities, and equities each represent? Assets are the resources with economic value that can be sold for money or bring positive monetary benefits in the future. For example, cash and marketable securities are a store of monetary value that can be invested to earn interest or returns. Account receivables are payments that are due from customers, and property, plant, and equipment is used to generate cash flows in the future, all representing inflows of cash. Liabilities are unsettled obligations to another party in future and represent the external sources of capital from third parties which help fund a company's assets. For example, debt capital, payments owed to suppliers or vendors. Unlike assets, liabilities represent future outflows of cash, whereas assets represent future inflows of cash. Equity is the capital invested in business and represents the internal sources of capital that have funded its assets. The provider of capital could range from being self-funded to outside institutional investor. In addition, the accumulated net profits over time will be shown here as retained earnings. So what are the typical line items one might find on balance sheet? In a balance sheet, one finds cash and in assets section, in current assets section, one would find cash and cash equivalents, marketable securities, accounts receivables, inventories, prepaid expenses, while non-cash, non-current assets include property, plant, and equipment, intangible assets, goodwill. So, delving onto each line item, cash in current assets, cash and cash equivalents. This line item includes cash itself and is highly liquid. Cash-like investments such as commercial paper and short-term government bonds. Marketable securities. These are the short-term debt or equity securities held by company that can be liquidated to cash relatively quickly. Accounts receivables refers to the payments owed to a business by its customers for products or services already delivered to them. Inventories are raw materials, unfinished goods, and finished goods waiting to be sold, and the direct cost associated with producing the goods. Prepaid expenses are payments made in advance for goods or services expected to be provided on later date, such as utilities, insurance, or rent. Non-current assets. In non-current assets, property, plant, and equipment refers to fixed assets such as land, building, vehicles, and machinery used to manufacture or provide the company's service and products. Intangible assets are non-physical acquired assets such as patents, trademarks, and intellectual property. Goodwill is an intangible asset created to capture the excess of purchase price over fair market value of an acquired asset. In a liabilities section, we would find in current liabilities, the line items would be account payable, accrued expenses, short-term debt. While in non-current liabilities, we would find deferred revenue, deferred taxes, long-term debt, lease obligations. So, going over each line item, accounts payable represents unpaid bills to suppliers and vendors for services and products already received but were paid for on credit. Accrued expenses are incurred expenses such as employee compensation or utilities that may not have been paid, often due to invoice not being received. Debt payments coming due within 12 months or with the current portion of long debt also included into short-term debt. Going over to the line items of non-current liabilities. Deferred revenue is the unearned income received in advance for goods or services not yet delivered to the customer. This can be either current or non-current. Deferred taxes is a tax expense recognized under GAAP but not yet paid because of temporary timing differences between book and tax accounting. Long-term debt. Long-term debt is any debt capital with a maturity exceeding 12 months. Lease obligations. Leases are the long-term contractual agreements allowing a company to lease property, plant, and equipment for a specific time period in exchange for regular payments. In shareholders' equity, the line items would be common stock, additional paid-in capital, preferred stock, treasury stock, retained earnings, other comprehensive income. So, common stock represents a share of ownership in a company and can be issued when raising capital from outside investors in exchange for equity. Additional paid in capital represents the amount received in excess over the par value from the sale of preferred or common stock. Preferred stock is a form of equity often considered as a hybrid investment and it has features of both stock and debt. Treasury stock refers to the shares that have been previously issued but were repurchased by company in a share buyback and are no longer available to be traded. Retained earnings represent the cumulative amount of earnings since the company was formed, less any dividends paid out. Other comprehensive income consists of foreign currency translation adjustments and unrealized gains or losses unavailable for sale securities. So, what are the line items that are present in a cash flow statement? So, uh, there are two methods by which cash flow statements are organized, direct and indirect. The most common approach is indirect method, whereby cash flow statement is broken into three sections, that is cash from operations, cash from investing, and cash from financing. Cash from operations. The cash from operations starts with net income and add backs non-cash expenses such as depreciation and amortization and stock-based compensation and then makes adjustments for changes in working capital. Cash from investing. The cash from investing section accounts for capital expenditure, typically the largest outflow, followed by any business acquisitions or divestitures. Cash from financing shows the net cash impact of raising capital from issuances of equity or debt, net of cash used for share repurchases and repayments of debt. The cash outflows from payout of dividends to shareholders will be reflected here as well. Together, the sum of three sections will be the net change in cash for the period. This figure will then be added to beginning of the period cash balance to arrive at ending cash balance. So how are the three financial statements connected? So the cash flow statement is connected to income statement through net income, as net income is the starting line on cash flow statement. While the cash flow statement is linked to balance sheet because it tracks the changes in balance sheet's working capital, that is current assets and liabilities. The impact from capital expenditures on PPE, debt or equity issuances, and share buybacks are also reflected on balance sheet. In addition, the ending cash balance from bottom of cash flow statement will flow to the balance sheet as cash balance for the current period. The relation between income statement and balance sheet is through retained earnings. Net income minus dividends issued during the period will be added to prior period's retained earnings balance to calculate the current period's retained earnings. Interest expense on income statement is also calculated of the beginning and ending debt balances on the balance sheet. And PPE on the balance sheet is reduced by depreciation, which is an expense on the income statement. So, what is the revenue recognition and matching principle used in accrual accounting? So, revenue recognition principle is wherein revenue is recorded in the same period the good or service was delivered and therefore earned, whether or not the cash was collected from the customer. Matching principle is the principle wherein the expenses associated with production or delivery of a good or service must be recorded in the same period as and when the revenue was earned. So, how does accrual accounting differ from cash-based accounting? So, for accrual accounting, revenue recognition is based on when it's earned and its expenses associated with that revenue are occurred in the same period. Under cash basis accounting, revenues and expenses are recognized once cash is received or spent, regardless of whether product or service was delivered to the customer. So if the company acquired a machine for $5 million and generated 3 million in accumulated depreciation, so the PPE has a fair market valuation of 20 million. So under GAAP, what would be the value of PPE on that balance sheet? So the short answer would be 2 million, except for certain liquid financial assets that can be written up to reflect their fair market value. The companies must carry the value of assets at the net historical cost. Under IFRS, the revaluation of PPE to fair value is permitted. Even though permitted, it is not widely used and thus not well known in US. So, what is goodwill and how it is created? Goodwill represents an intangible asset that captures the excess of purchase price over fair market value of an acquired business net assets. Suppose an acquirer buys a company for 500 million purchase price with a fair market value of 450 million. In this hypothetical scenario, a goodwill of 50 million would be recognized on acquirer's balance sheet. Or we can say goodwill is the excess premium paid over the fair value and is created to plug this gap for the balance sheet to remain in balance. So, what is the going concern assumption used in accrual accounting? So, in accrual accounting, companies are assumed to continue operating into foreseeable future and remain in existence indefinitely. The assumption has broad valuation implications given the expectation of continued cash flow generation from the assets belonging to a company as opposed to being liquidated. So, what was the role of fair value accounting in subprime mortgage crisis? So, in the worst case scenarios, sudden drops in asset values would cause a domino effect in the market. An example to this would be the subprime mortgage crisis, in which meltdown's catalyst is considered to be uh, Financial Accounting Standard Statement of 157. This mark-to-market accounting rule mandated financial institutions to update their pricing of illiquid securities. Soon after the write-downs in financial derivatives, most notably credit default swaps and mortgage-backed securities ensued from commercial banks, it was all downhill from there. So if the share price of a company is increased by 10%, what would be the impact on balance sheet? So there would be no change on balance sheet as shareholders' equity represents the book value of equity Equity value, also known as market cap, represents the value of company's equity based on supply and demand in open market. In contrast, book value of equity is the initial historical amount shown on balance sheet for accounting purposes. This represents the company's residual value belonging to equity shareholders once all of its assets are liquidated and liabilities are paid off. Book value of equity is the total assets minus total liabilities. So the equity value recorded on the books will be significantly understated from market value if the share price of the company increases by 10%. For example, the book value of Apple's common stock is only $51 billion dollars as of the latest 10K filing for financial year 2020, whereas its market value of equity is over 2 trillion as of 2024. So, what is deferred revenue? So, deferred revenue or unearned revenue is a liability that represents cash payments collected from customers for products or services that are not yet been provided. Such examples are gift cards, service agreements, or implied rights to future software upgrades associated with the product sold. In all the examples listed, the cash payment was received upfront and benefit to customer will be delivered on a later date. For instance, a company that sells a smartphone for $500 might allocate $480 of the sale to the phone and remaining $20 to the value of the customer's right to future software upgrades. Here, the company would collect $500 in cash, but only $480 would be recognized as revenue. The remaining $20 will be recognized as deferred revenue until the software upgrades are provided.